Disclaimer: the content presented in this podcast is intended solely for general informational and educational purposes. Nothing herein constitutes or should be construed as financial, investment, legal, or tax advice. You should not act or rely on any information in this podcast without seeking the advice of a qualified financial professional. This audio/video podcast is an AI-generated product produced using Notebook LM. It automatically summarizes and synthesizes reports, analyses, and commentary originally published at reflectionsofreality.substack.com. All views, opinions, and analyses expressed are those of the original author and do not represent the views of any financial institution or regulator. Past performance is not indicative of future results. All investments involve risk, including possible loss of principal. All reflections of reality, all original content rights reserved. Okay, welcome to today's explainer. We've got a really fascinating synthesis lined up for you, blending prediction market odds directly with institutional capital flows. Here's our roadmap. We'll start with the convergence methodology, move into Lens 1, which covers polymarket odds, and then Lens 2 for flow and breadth. After that, we'll see exactly where the lenses agree, uncover the silent gaps, and wrap it all up with some actionable market intelligence. Section 1. The Convergence Methodology. So, how does this actually work? Well, the framework uses two totally independent lenses. Lens 1 is the polymarket macro monitor, which feeds us forward-looking, crowdsourced event probabilities. Lens 2 is the weekly market intelligence brief, and that provides the flow and breadth machinery. Basically, it tracks what institutional capital is doing right this second. When we synthesize these into the convergence brief, it's like a giant puzzle coming together, revealing exactly where the market narratives either corroborate each other or conflict on the swing horizon. Section 2, Lens 1, Polymarket Odds. Now, the extreme conviction priced into these odds is honestly pretty wild. Let's look at the monetary regime. The crowd is pricing in a near zero, specifically 0.1% probability of an aggressive 50 basis point Fed cut in July. That establishes a very firm hawkish Fed anchor. And jumping down the list, there's only a 7.5% chance that traffic in the Strait of Hormuz normalizes by July 31st. Flip that around, and you've got a massive 92.5% implied probability of continued disruption. That establishes a persistent geopolitical risk premium, which definitely supports energy upside. Section 3. Lens 2, Flow and Breadth. Okay, so before we look at the data, we need to know exactly what we're measuring here. The Market Valuation Index, or MVI, strictly measures how attractive stocks are versus bonds after adjusting for the business cycle. It's showing us the cyclical equity risk premium, not raw valuation. So, high or positive readings mean stocks are cheap and rewarding relative to yields. Deep negative readings, that means stocks are expensive and risky relative to yields. Bringing in our current data, the MVI for SPY sits at negative 0.49 and QQQ is at negative 0.51. That signals stocks are slightly expensive right now, the equity risk premium is shrinking. But the real standout is the Russell 2000, IWM. It's flashing a deep negative reading of negative 1.11, which is a severe warning. It's telling us systemic risk is building and small caps are carrying a heavy valuation penalty relative to the business cycle. Let's define a couple more proprietary indicators to really understand the broader market regime. MT Bull indicates the trend through gamma positioning. MT Health, on the other hand, tells us about breadth, basically confirming how many individual stocks are actually participating in the move. And what we're seeing right now is a fascinating split regime. The MT Bull trend is constructive, sitting nicely above 50% at 59.8%. But the MT Health indicator is sitting at 43.3% bearish. So breadth confirmation is completely absent. The advance we're seeing relies entirely on narrow participation. This boldly reveals a massive paradox in our current market. We are supposedly in this Goldilocks macro setup that should be inviting accumulation, but instead the dominant institutional state is rotation out, hitting a massive 28.3%. Accumulation is incredibly weak at just 7.8%, which is explicitly below the 10% threshold needed for meaningful conviction. So what's happening? Institutions are literally treating this advance as an exit opportunity. Section 4. Where the lenses agree. So, what happens when we read these two distinct data sets side by side? When we compare the polymarket odds against the weekly rotation map, we find exact points of convergence. And this is exactly where those high conviction positioning decisions get made. The most striking agreement we found is on the monetary regime. That hawkish Fed anchor from Lens 1, the one giving just 0.1% odds for a 50 basis point cut, is completely corroborated by Lens 2. On the tape, we're seeing the liquidation of TLT, IEF, and LQD. This proves that duration is being systematically unwound by real money, not just hedged. We can map out the overall convergence verdict across 3 major dimensions, where the lenses completely agree. First, they agree on monetary policy. Second, they agree on energy risk, pairing those low odds of Hormuz normalization with USO and OVV both sitting in accumulation. And third, they agree on AI infrastructure dominance. The crowd gives NVIDIA 92.5% odds of remaining the largest company, and the tape backs that up with accumulation states in AVGO, NVIDIA, and BLK. Section 5. The Silent Gaps. The brief makes a brilliant point about divergences. It states, quote, "The gap is the trade, not noise." When prediction markets fail to capture reality and go silent, that's where the actual opportunities for portfolio positioning emerge. Right now, the most critical gap is breadth and systemic fragility. Bali market is totally silent on this. It simply cannot price systemic breadth collapse risk. But our flow and breadth tape internals are exposing this building risk loud and clear. MT Health is 43.3% bearish, and the IWM MVI is deep in the negative at negative 1.11. So institutional money is acting like a coiled spring, even while the prediction markets stay completely quiet. Section 6. Actionable market intelligence. When it comes to deploying fresh capital, the framework applies a very strict rule based on a concept called triple play. We only deploy capital where triple play is confirmed on an individual name. And to be precise, triple play is defined strictly as a high conviction alignment of 2 things, the bull percentage and positioning. A prime example of this in action is SPY in the KISS book. SPY holds an accumulation state and aligns perfectly with triple play and that overarching Goldilocks regime. It's sitting squarely on the convergence gap, fully supported by the hawkish Fed anchor, the caps multiple expansion. That keeps it as a firm hold. Conversely, the tape gives us a heads up when positions start running against us. We're seeing massive momentum erosion warnings in some specific names. DHI, for instance, is facing a 26% one-week collapse, fighting XHB liquidation and a hawkish Fed. Then there's TSM, suffering a severe 29.7% one-week momentum erosion, which is being compounded by silent geopolitical risk in the Taiwan Strait that Polymarket just can't price. And Goldman Sachs is sitting in a liquidation state, down 22.4% for the week. Which brings us to one final critical thought. The crowd odds are telling one story of conviction, but the tape internals reveal institutions rotating heavily out of this very rally. So if institutional capital is treating the advance as an exit opportunity, while the crowd stays glued to the headlines, which side of the tape will you trust when that coiled spring finally releases? It's definitely something to consider for your own swing horizons. Thanks for joining me on today's Explainer.